Hello, and welcome to On Watch by MarketWatch. I'm Jeremy Owens. Markets have enjoyed a start to the year for the record books, with indexes at all-time highs despite diminishing expectations for interest rate cuts. Why has this year been so good for markets, and what comes next? We'll talk with MarketWatch's editor-in-chief about what's in store. Then, one of the world's most popular video games has spawned a gambling ecosystem that attracts thousands of players who literally have their skin in the game. We dive into the economy of Counter-Strike Global Offensive. Plus, we'll take a quick look at the news stories we're watching right now and how they'll affect your wallet. First, let's talk about the markets. In case you haven't noticed, markets have been on fire so far this year. The S&P 500 is having its best start since 2019, after its best February since 2015. Going back even farther, the index has now increased 16 of the past 18 weeks, a feat unseen since 1971. And all three major indexes, the S&P, Dow Jones Industrial Average, and the NASDAQ, have now all surpassed their record highs, after the tech-heavy NASDAQ broke through its all-time high last week. But stocks aren't alone. Cryptocurrency is also rebounding, with Bitcoin hitting a new all-time high, and Americans are piling money into government debt in a quantity we haven't seen in decades. Now, is all of this good news, or signs of a fresh bubble? To answer that question, we went straight to the top of the MarketWatch masthead. We're joined now by Mark DeCambre, our editor-in-chief. Oh, Mark, if you went back to the end of last year and told me we'd be sitting here with all three indexes at fresh record highs, such a strong beginning to the year, I probably would have said, well, then I'm guessing the Fed is cutting interest rates. But that's precisely not what happened. In fact, the economy is getting stronger. Inflation is staying above the 2% rate. It's looking even more like it's going to be longer that we're going to have higher interest rates. So what's really behind the exuberance in the markets and the record highs we're seeing right now?
We find ourselves in this curious place where interest rates are still historically high, but also historically high are stocks. All the major indexes have reached record highs, and a lot of people looking at this find that quizzical.
Yeah, including me. I've been very surprised by this. And just looking back at the last 2 months, it does strike me as, if you just look at what's happened with the Fed and the economy, if I'd known that, I would have bet against stocks. But instead, stocks have also risen to a record high. That's where that disconnect is really central to how to look at the market right now to me.
Yeah, I mean, there is this sort of thinking in the market about whether or not Jay Powell, the head of the Fed, is more important than Jensen Huang, the CEO of NVIDIA. And that's sort of as much to say that there is a category of stocks driven by artificial intelligence and the prospects of growth therein that has really been a big driver that's almost defied the expectations of many. And here we are in a much, much different place than people expected.
Yeah, including me, right? I was a pessimist. I am still kind of a pessimist. I think what we're seeing so far in terms of AI results is so concentrated at the top of the market. But we already have kind of a top-heavy market. Is that a concern for you? Do we need to see more of a broad-based gain to feel more secure in where we're at?
You know, the fact that the NASDAQ 100, these are market cap weighted indexes, means that those stocks, those companies with a higher market cap are going to have a greater influence on those indexes, right? And we're still at records. But by and large, the general thinking is like, you got to have a good chunk of these big companies who have such tremendous influence on these indexes move higher for the market to continue to move higher.
Yeah, but we also need to see the small guys also come along. We've seen some inflows into small cap ETFs, especially from retail investors. It's starting to look like we're getting some inflows into those smaller companies and away from the top of the market. And is that worrisome, or is that a sign of health?
I mean, to your implication, we need to see a little bit more of distribution away from the giants and to some of the smaller players. I mean, that makes it all equitable, but that also makes a lot of people more comfortable about the sustainability of this run higher.
Yeah, and that's the concern a lot of people have. Is this a bubble or is it not? I've kind of explained how this could be an Nvidia fueled bubble, just as the .com era was a Cisco infused bubble, right? That we could be seeing something similar to that in the current setup.
That happens, right? That happens when you're in a period of time where you don't know exactly what the future looks like. And the playbook isn't clear because the dynamic of artificial intelligence and AI and what that means for other companies, not just NVIDIA, but across the spectrum of companies, what that means for their valuations, what that means for their businesses. That's sort of an open question.
I've seen a lot of people, kind of say, look, it's not a bubble, but we are definitely due for a pullback here. And I almost wonder if we're looking at the inverse of a couple of years ago when the first half was really tough from an earnings standpoint, from a stock standpoint, but then we started to see the recovery in the second half. Are we headed to the opposite here where we're looking strong in the first half and then we struggle in the second half?
It's a very good question. And a lot of this has been driven on expectations or concerns about the economic backdrop. At points months ago, we were just thinking, will the Fed conquer inflation or will inflation be overwhelmed? By the way, the idea that inflation has been conquered is still, I guess, in some circles, an open question. And we'll learn more of that later, but still an open question about where we're headed from a macroeconomic standpoint. But from an investment standpoint, U.S. shares are still seen as one of the best games in town in the world. So I think that's also a big driver of some of the valuation, some of the multiples that we've seen over the course of these last several months or so. There's been a lot of money on the sidelines that is starting to try to find a place to be put to work. We've talked about this idea, we've written about it, that there's, a $6 trillion pile of cash in money market funds. And as we think about the prospect of interest rate cuts by the Fed, what you could see, and this is based on what we've reported, but what you could see is investors moving those funds out of lower interest rate bearing assets and into riskier investments like stocks. And that could deliver a further snap up higher. So that amount of money on the sidelines, it's no guarantee that it gets put to work into equities, but it does suggest that there is still dry powder out there. And that dry powder could result in another ignition higher for equity assets, for risk assets at large.
Yeah, and they're not just looking at stocks with all that money on the sidelines. We've definitely seen crypto come back this year in an almost unexpected way, and people seem to be jumping back into that market in a way that maybe we didn't expect.
Yeah, totally. There's some other things at play when it comes to crypto, with Bitcoin likely to see a halving. So that is driving this idea of sort of scarcity in Bitcoin. And where Bitcoin goes, other altcoins, other crypto tend to follow.
Right. So it's a similar setup to the market where the top of the market is kind of guiding higher and people are looking for deals below. We're seeing the same thing in kind of the crypto market right now, basically.
Bitcoin's definitely a sentiment driver in that respect. The other big driver is spot-based exchange-traded funds that have Bitcoin as their underpinning, and that has driven a lot of appetite for that asset.
We've definitely seen that treasury bills and other kinds of government debt are now investable for people in a way it has not been for many, many years. What are you looking for from that market, and what are we going to see? Is it going to be more volatile? Are we just waiting for a cut to see any kind of change in that market, or what do you see coming from there?
This is an environment where we're seeing some opportunities to put fixed income back into their portfolio without suffering hefty losses. We might actually start to see asset managers going back to this idea of a portfolio composition that's closer to 60-40. But I think there's been a rethink of fixed income and bonds. And on top of that, bonds that are tax efficient, including like muni bonds. So there's definitely more thinking around those assets. And I think that's a good balanced thing for investors. So we'll see how that plays out.
Mark, thank you so much for joining us. We'll talk to you again later in 2024 to see how it's going.
Thanks for having me, Jeremy.
We're going to take a quick break. Coming up, how video games are pushing some teenagers into gambling. Stay with us. Welcome back to On Watch by MarketWatch. Before the break, we talked with Mark DeCambry about where the market is now and where it's headed. Now we're turning our attention to a very different story. I'll let our guest introduce it.
Yeah, so a while ago, I was talking to my friend on the phone. Hi, Xander, if you're listening. And he told me that he was not investing in stocks. He was investing in Counter-Strike skins. And I said, what the hell are you talking about? And here we are, 6 months later.
That's Nick Dever, Barron's reporter and social media editor. He's talking about how he started investigating a recent Barron's cover story. That piece exposed a global gambling ecosystem that has sprung up around the video game Counter-Strike Global Offensive. Here's a look inside that ecosystem. Players buy digital goods in Counter-Strike known as skins. More on those in a minute. Other websites allow players to gamble their skins, potentially trading up for more valuable goods or cashing out, usually for cryptocurrency. And while the game's creator, Valve, has rules against gambling sites, Nick's investigation found that dozens of sites are using Valve's software to facilitate gambling. The game's players likely know about these sites, but if you're not one of those, you might be surprised to hear that kids as young as 13 are finding their way onto internet gambling sites via the video game. We asked Nick to explain to us exactly how that's happening. So, Nick, I'm not a huge gamer. My video game practices now are basically Candy Crush on the bus and some 2K sessions with my other dad friends. So, explain to me exactly, how big Counter-Strike is in the video game world.
I think maybe a better way to look at this in terms of scale is to talk about Valve, the company that is behind Counter-Strike, the video game. So in 1996, when Valve was founded, they were just a small indie studio, and then they began to release games like Half-Life, games like Team Fortress, Portal, big IP that in the PC gaming world, these are like Mount Rushmore games, like the best games that can be played. So in Counter-Strike, you are seeing through the eyes of the character you're controlling. There's a gun in a character's hands on your screen, and with mouse and keyboard, you're moving around with a team of 4 playing against another team of 5. It's terrorists versus counter-terrorists, and you're racing to either plant or defuse a bomb or eliminate all the other players on the team in multiple rounds in a match.
And how many people are playing this game for hundreds and hundreds of hours?
The scale of it, I think it's helpful to understand that because it's a PC game, it's quite a global phenomenon. And another thing that sets it apart is first-person shooters like Call of Duty or Halo. There's multiple iterations of these games. There's a new Call of Duty every year. Whereas with Counter-Strike, the most popular version of the game, Counter-Strike Global Offensive, or CSGO, is a game that came out in 2012, and it did not get a sequel or a follow-up until September of 2023. So it has an extreme amount of longevity, and the learning curve is also very high, so you get rewarded for the amount of time that you put in. And so that creates a lot of loyalty in the people that play the game. They want to play it for a long time. So it's got up to about 1 million players a day on average at any given time. There's usually about 1 million people logged into Counter-Strike, and it's been downloaded hundreds of millions of times. It's exceedingly popular.
And that means lots of money. For Valve, players are spending so much money on these skins, which are basically costumes or weapons for their characters in different colors or patterns or things like that. And that has created a whole economy around Counter-Strike.
Yeah, so to get a new skin, you open a loot box. A loot box is something that's freely given to the players, and inside that loot box, which you pay to open, is a random skin. And so when you open this loot box, you're paying $2.50. That goes straight to Valve. And then from there, depending on what skin you get, you can keep that skin and just continue to play and, see other players' skins. Or if you aren't interested in keeping the skin or you want to try for another one, you can go on Valve's marketplace that they've created and sell your skins to other players. Now, the fact that you can do this creates an inherent value for the skin outside of just the $2.50 fee that you pay to get it in the first place. And because some skins are rarer or more unique than other ones, they start to go for higher and higher prices. And because there's this secondary market value, people realized that we can get people to exchange them for what amount to chips at a casino, but it's all happening online. In just a few seconds, you can be on a third-party gambling site and see the skins that you have in your Valve inventory and then send them to the gambling site, and they will send you back chips that you can gamble with freely. And then you can exchange those chips for a better or different or more expensive skin than the one you started with. And that's facilitated through gambling. And, it's also important to note that when I'm selling an expensive skin on Valve's market, Valve is taking a 15% cut of all of the skin sales being made on its market. So these third-party marketplaces are indirectly pushing up the price, and Valve makes more and more money indirectly because the skins are able to be used on gambling sites.
And Valve says that it has regulations against gambling sites using its API, right? They say that there are rules against exactly what you're talking about.
Valve has extremely explicit terms that ban this kind of activity, and in the past has acknowledged that it exists and acknowledged that it has taken action, proactive action, to try and stop these things from happening. So Valve is not only aware that it is happening, but has tried to do something about it. Our investigation basically turned up that the actions that Valve had taken when a regulator in Washington state, where the company is headquartered, started looking into them, they were prompted to start taking a little more proactive measures in going after these gambling sites. And so Valve told the Washington regulator, look, we've sent 42 cease and desist letters. We've notified these casinos that they're not supposed to be doing this. We've made it clear to our users that this activity is not allowed. The prosecutors who were looking into charging Valve decided that this case that they were, facilitating an illegal wagering of skins, they would probably have a hard time proving that in court. So the regulator said, okay, they were convinced that Valve had the tools to take care of this, and Valve sent these cease and desist letters. Well, what we turned up is that 7 years later, 6 of the sites named in the cease and desist letters are still operating. And in the time since those 42 sites received cease and desist letters, our investigation found that there are now 73 skin gambling sites using Valve's API in this exact same way. So while Valve has said that it has rules against this kind of a thing, and it has sent cease and desist letters, and it's taken proactive measures, when you really look not too much deeper, you can see that this sort of gambling ecosystem really has its hooks very, very deep into Valve's software, into the ecosystem that makes it money, into its player community. It's really permeated every single aspect of this game.
And this Counter-Strike economy goes well beyond Valve and touches a lot of other companies, including very large tech companies. A lot of streams that show people playing the game are doing gambling are on Twitch, which is owned by Amazon, and YouTube, which is owned by Google. Now, those two companies also have a lot of content with, gambling and sponsored by these gambling companies. And when you show them the rules are being broken, what happened?
So any plain reading of the rules from YouTube or Twitch, it's pretty obvious that any promotion of skin gambling or content that features skin gambling, in my reading, goes against their rules. And we provided spokespeople from YouTube and Twitch with multiple explicit examples of this behavior occurring. And we were told that, they would look into it, and that once they looked into it, they were unconvinced that it violated their community guidelines. And, the thing that really is interesting about this is just how prevalent skin gambling content is on Twitch and YouTube. Of the top 300 Twitch streamers that stream Counter-Strike content, 120 out of those 300 are sponsored by skin gambling sites. Of the 3 most popular Counter-Strike YouTubers, those 3, all of them, are sponsored by skin gambling sites, and they have a combined following of more than 11 million. And in fact, 2 of them, their entire accounts are dedicated to skins and to loot boxes and this side of CSGO that has nothing to do with the actual game itself. So a huge, huge portion of content that's being made about this game is about the economy that is fueled by these skin gambling sites.
Well, Nick, thank you so much for joining us. You run Barron's TikToks, right? So you can find Nick on TikTok under the Barron's account, and you can find this story on the web. And it was really a great story. I appreciate you for writing it, Nick, and I appreciate you for coming on with us today.
No worries. Thanks for having me, Jeremy.
Before we go, it's time for What We're Watching, a look at the news you need to know for the rest of the week and beyond. The European Union levied a record $2 billion fine on Apple this week, and that could be just the beginning. The penalty focused on Apple using its dominant position to boost Apple Music against competitors like Spotify. Apple expects to challenge the decision, adding to a winding appeal it already faces in Epic Games' antitrust suit, which is centered around Fortnite. Next up is expected to be an antitrust suit from the U.S. Department of Justice, which could take a larger focus on Apple's approach to its platform. Federal Reserve Chair Jerome Powell told Congress yesterday that he expects the central bank to cut interest rates this year, but wants to see inflation move closer to 2% before making that move. Now, this approach is not a big change from previous statements from Powell, but markets reacted positively as it suggests recent inflation readings haven't made him more hawkish about rate cuts. Regional bank stocks did struggle, however, as Powell said that problems with commercial real estate were a shock to the system that could take years to resolve. Tomorrow, we'll find out how the labor market performed last month. After January's jobs report trounced expectations, economists expect that more than 200,000 jobs were created in February. This strong labor market has been essential to the economy and the market, so the results of this report will be watched closely. The report also arrives just before Equal Pay Day on March 12th, which advocates use to call for closing the gender wage gap. We'll talk more about the jobs market and equal pay next week. And that's it for this episode. Thanks to Mark DeCambry and Nick Dever. To keep following the latest on markets of all kinds, head to MarketWatch.com. You can subscribe to the show wherever you get your podcasts, and please do. If you like what you heard, please leave us a rating or review. It really helps others discover the show. And let us know what you want to hear from us. You can reach us at onwatch@marketwatch.com. And if you're a listener on Spotify, be sure to answer this week's poll. The show is hosted by me, Jeremy Owens, and produced by Meta Lutsoft and Katie Ferguson, who also mixed this episode. Melissa Haggerty is the executive producer. We'll be back next week with a new episode, and until then, we'll be watching.